Hey, everybody, welcome to another episode of the Dude Real Estate Show. Today, we're going to be talking about financing your first rental property, or it could be any rental property or flip. We're going to go basically from the simple way of financing to a more complex models. So we're going to kind of run the gamut here. And I've got Billy here. I don't know his experience in financing, but we'll find out soon. Billy, how are you?
Hey, I'm doing well. I'm excited to learn something new today. Every day is a new day to learn.
Yeah, exactly. You have bought your own personal residence, correct?
Correct.
Okay. So I'm assuming you financed that?
Yes.
Okay. Do you remember what kind of loan you got or what kind of the basic terms of it were?
Ooh, good question. Well, it was a 30-year fixed mortgage. It's not an FHA or anything like that. It's just a conventional loan. Um, yeah, nothing super special. Did a down payment, and yeah, have a
Okay.
monthly loan that we have to pay every month.
Right. So you mentioned two words there. You said FHA and conventional. So those are kind of the two starting points for
Mhm.
the very basic, what most homeowners get. They're going to get one of the two, a conventional
Mhm.
loan or an FHA. Let's start with conventional. So conventional, in the past, it pretty much meant that you're putting down about 20%,
Mhm.
and then it would be amortized over 15 or 30 years, depending on what you wanted to do there. Uh, when I say it used to be 20%, a lot of people still do put the 20% down, but there's an option now to put less down. So you can put as little as, I think, 5% down. There might even be some special programs where it's a little bit less.
Mhm.
The downside of putting less money down is obviously your payment's going to be bigger, but then also they're going to attach PMI or private mortgage insurance to it, which is an extra payment as a portion of the loan until you hit that 20%, because the bank is taking a little more risk if you're putting a little bit less money down. So they want a little bit more money month to month, just in case something were to go south with your loan. So an FHA loan is typically considered one of those low down payment loans. You can go as low as 3.5% down. Again, you will have PMI until you get to that 20% level on the loan. And FHA can be good, especially for something like house hacking. So, for those who are not aware of what house hacking is, essentially you buy a 2 to 4 unit property, you live in one of the units, you can put as little as 3.5% down with an FHA loan, rent out the other unit or units, have them cover a lot of your expenses. And the nice thing about that is not only are they covering a lot of your expenses with your living situation, but you get experience as a landlord. So I think it's kind of a win-win there, but it does depend on what stage of life you're in and what's available in your area, things like that. So that's FHA and conventional. Those are the two very basic ways to finance pretty much any 1 to 4 unit property. Obviously, there's cash. If you have enough cash to buy a house outright and that's something you want to do, you don't have another use for that cash and you don't want the payment, that's certainly always an option. But for most people, that's not an option.
Mhm.
And so then we can get into some other different types of ways to buy properties. There's quite a few. Let me just pull these up. So next we'll talk about, let's talk about a popular one. Everyone likes to throw around the word no money. They want to buy
Yeah.
real estate with no money. And while this certainly is possible, and I've done it many times, I wouldn't necessarily recommend it for a newbie.
Mhm.
There's some risk there because essentially if you have no money out of pocket, that money has to come from somewhere. So essentially it's going to come from a friend, a family member, somebody that you know is going to give you money, but you have to give them something in return. Usually it's going to be in an interest rate. You guys set the terms in advance, what the interest rate's going to be over a certain amount of time,
Mhm.
or you give them some sort of back end equity. Like let's say you're flipping a property and they give you money. You could do like a 50-50 split. You do all the work and they fund the purchase and the rehab on the back end. Hopefully you made money and then you split the profits, 50-50. I've done that. So there are ways to make that work. The trick, with potentially buying a rental property though, with no money down, using someone else's money, is it's usually going to be a longer term affair, because unless you're able to refinance out of it and completely get out of it, which would be unlikely, that investor is going to have some sort of interest in the property for a much longer period of time. And not everyone would want to do that necessarily.
Hmm.
Um, then you've got something called hard money. And I definitely don't recommend this for beginners. Hard money is essentially private money, but more like in a commercial asset class, a commercial lender. And so you can go to a hard money lender. They will give you money to do a purchase and a rehab. Typically, this is used for flips, just because you don't want to be borrowing this high interest rate money for a long period of time. You want to
Hmm.
be in and out as quickly as possible, because typically they're like 6 to 12 month terms anyway. Now, if you're able to get in there, do a quick rehab and do a cash out refinance and put like a regular mortgage on the property, hard money could be a way to do it, but you still need a down payment to do hard money. So you're still going to need anywhere
Hmm.
between 10 and 25% to put down. um, and then you have both points. Points is usually 1% of the loan, so there might be 2 or 3 points. And then you've got interest only payments during the life of the loan, and then obviously you have to pay off the loan at the end of that, whether it's a 6, 9, 12 month term. So it's very expensive. It's a little bit of a headache, a lot of hoops to jump through, and there's a lot of hard money lenders out there, and they're a little difficult to vet. I've used, I think, 3 or 4 separate hard money lenders, just because I wanted to keep trying new ones, because none of them were perfect. So I'd ask for referrals, I'd do some research, and each one had their strengths and weaknesses. Again, not for the new investor, but once you get some experience, especially on the rehab side, so at least you know how that all works, it could be an option, especially if you know you can turn a property really quickly. Uh, One thing I would do sometimes, because this is typically, if you don't have a lot of money too, I would do no money, what we talked about before, but combine it with hard money. And I would call it kind of a hybrid model. So what I would do, I would line up the hard money loan. And then for the down payment portion and my carrying costs, I would bring in a private money lender. So they would kind of cover the down payment plus the carrying costs on the property. And I did make a mistake. The first time I did this, I brought in a private lender. They covered the down payment, and then I had my hard money lined up, and I'm like, good, I'm set to go. And I totally forgot about the carrying costs and the interest only payments that I had to do every month. So out of my pocket, I was paying for all the costs associated with the hard money loan, and the stuff like property taxes, utilities, just the ongoing costs of owning a property, even over a short period of time. So remember to get a little bit more money from the private money lender if you're using that strategy. Again, it's a little more advanced strategy there.
Hmm.
And you can either do an interest rate, or you can do like an equity split on the back end as well, with
Hmm.
something like that. Another option, if you do own your home and you have equity in it and you feel comfortable tapping into that equity, you can do a home equity line of credit or a Heloc. That's a
Hmm.
good way that a lot of people do. So if you have money in your house, you can go talk to your bank and say, hey, I've got this. I'd like to get a line of credit. And nice thing about that is it's pretty flexible, and you can use it whenever you need it, kind of thing. And so you could use that as like a down payment on a rental property. Let's see. Was there one more? Oh, yes. Last one. It's kind of the unicorn in the real estate financing world, but is seller financing. Hard to find for a couple of reasons. One, the last 10, 12 years, there hasn't been a lot of seller financing out there because it's been such a hot market on the seller side. So they know that they can get a buyer without having to offer something like seller financing.
Hmm.
Um, Another thing to think about is that the seller needs to own the property outright. There are some creative ways you can kind of get around that. If they do owe some money on the property, you could do like a wrap mortgage or something like that. But yeah, they need to own the property outright, and then you can come to terms with them if they're okay with the terms you set forth. The purchase price, the term, the interest rate, all
Mhm.
that kind of stuff, that can be a great way to get into a property. And sometimes it can be no or low money down for something like that. And sometimes what I see with these deals is like, it might be a 5, a 7, a 10-year term, depending on what the seller wants. And then
Mhm.
at some point along the line, you'll just refinance into a conventional mortgage, but that can be another way to finance a property. So I know that was a lot to cover there. That's kind of the simple to complex. Do you have any questions about those things? Or is there a certain option that I mentioned that maybe has interest to you, or you have questions about?
Yeah, so I think, yeah, it's amazing. There's a ton of options to finance real estate. I'd be curious what you've seen with more experience, what a typical first-time person, what they can expect for a mortgage. If, let's say, for example, they just want to do a commercial 25% down loan with a bank, what kind of terms can they expect? Um, what usually the amortization schedule is only 5 years or 7 years. It's less than the entire 30-year loan. Maybe we can get into that a little bit.
Yeah, so if we're talking about a commercial loan, that yeah, it's going to look a little bit different. But yeah, you're going to probably put down 25, sometimes even 30%. Sometimes, depending on the asset class, it could be even more.
Hmm.
Right now, commercial lenders especially are really tightening up, and I've seen where they want 40, even 50% equity in a property to carry half that loan. But in a typical normal economy, yeah, 25% down, and then you'll have, like, yes, a 5 or 7 year term, and you're probably going to either refinance or sell. You could extend the term. Of course, the risk always there with those shorter outlooks is that interest rates could rise, the
Hmm.
real estate asset class could turn sour, and you might
Yeah.
not be able to find a buyer, or you might not have tenants in place, or whatever. So there is some risk there. But the nice thing about commercial real estate, since we're talking about it, is that unlike residential real estate, so residential, especially when it comes to lending and valuations,
Hmm.
is 1 to 4 units. So commercial is usually five or more. So it could
Hmm.
be an apartment building, it could be a 6 unit apartment building, or it might be a shopping center or something like that.
Hmm.
The nice thing about commercial real estate is that the valuations are really based on the numbers. So you're
Hmm.
looking at your net operating income in that case.
Hmm.
Whereas with residential, it's purely comp based. So if there's another 3 unit property in town that kind of matches your 3 unit property and that sold for $200,000, that's what an appraiser is going to roughly value yours at as well. So you're at the mercy of whatever is comparable
Hmm.
in a given area. The problem with that is if there's distressed properties or if values are just going down, I mean,
Hmm.
in any given market, it could just fluctuate a lot and cause some headaches. The nice thing about commercial though is that you can really manipulate you know, in a fair way. You can
Hmm.
manipulate those numbers. The greater your NOI and the more you decrease your expenses and raise rents and stuff like that, you can push the value of the commercial property much higher, and you can do it
Hmm.
fairly quickly. So just to give you an example, um, we purchased a 20-unit apartment building a couple of years ago. We saw that the rents were artificially low. We bought the property for 475, and a lot of the rents were around 375 a month, 350 a month, some of them, and we've been raising them all up to 400 to $450 a month.
Hmm.
And so now the property is probably valued around $650,000 just based on that value add, where our expenses are pretty much the same,
Hmm.
but we've been able to raise the income on the property. So our NOI goes up, and then there's a calculation I can never remember it off the top of my head, but with the cap rate and the NOI, you can figure out what your valuation is.
Okay. Yeah. So for someone starting out, um, I guess what recommendation would you make? What route should they go? It sounds like not hard money, but where would you start if you had to start?
I would most likely start with either the FHA or the conventional.
Okay.
And I think, especially for your first deal, it's good to have your own money in the deal. because you're
Mm.
going to learn a lot more from it, and you'll get a lot more equity long term because of that.
Sure.
So I encourage people to save up as much money as they need to for their first deal. And if people are able, I think house hacking is just such a great strategy because you can get in with a very low down payment and you
Mhm.
get a property. And then after a couple of years, you can move, do it again, and keep that same loan on there. You're allowed to do that,
Mhm.
and put in a tenant in your unit. And it's just a great way to build wealth that way. Like, even if someone just did that 4 times over the course of their life, they bought, four unit properties, and they did that
Mhm.
4 times, and they could do that, say, in like 8 or 10 years, something like
Mhm.
that. uh, they could pay off those units fairly quickly, and they'd have 16 units, paying them a nice little income
Yeah.
down the line. So I think that's a great way to go. Not everyone is up for it. There
Yeah.
might be, like we talked about in the last video with spouses, like sometimes they're not going to want a house hack. They don't want to live in a multi-unit property.
Mhm.
Um, so you might be buying a single family or renting. Um, so house hacking is one thing, or just go the conventional route, or use a Heloc and
Mhm.
essentially use that as down payment money, but use a conventional loan to buy your first rental property. Of course,
Sure.
flips are a little bit different, but I think for the most part, we're talking about rental properties.
Okay. Do you have like a rule of thumb how much, maybe not, I know every market's different, so maybe not for down payment, but what kind of reserve do you go by a percentage, or how do you determine like, okay, if I buy this, I already have this much saved for reserve, I should be fine.
That's a really good question, and that really depends on the condition of the property,
Yeah.
any downside that there could be. Obviously,
Mhm.
you're going to plan ahead with your numbers for things like capex and vacancy, but
Mhm.
that still may require you to have a certain number of reserves. So let's just say everything with the property is great except the roof. The roof has maybe 5 years left on it,
Yeah.
and it's going to be 8 grand to replace the roof.
Mhm.
So you need to be sitting on probably, double that to cover that and any unknowns, like if there was like
Yeah.
a water main, or just other things that could pop up, like other vacancies, things like that. I mean, it's just, it gives you a lot of, the more money you have in reserves, the more peace of mind you have. So I guess it really kind of depends on your risk tolerance, and
Sure.
maybe some of your other assets, like maybe you can fall back on borrowing from your 401k for a short-term loan to cover something like that, knowing that you
Sure.
can make it back. Um, so yeah, it depends on your risk tolerance, but it's good to have money behind you for a lot of different reasons. But yeah, I think it's the biggest things that you want to consider. If so, when you're doing the home inspection, you're going to know the age of all the mechanicals and the
Yeah.
major things like that. Maintenance is another thing. That's smaller numbers. You're going to plan on 5 to 10% of your monthly budget to kind of cover maintenance type things. But capex is stuff like your roof, your driveway, all the windows, your HVAC system, stuff like that. So,
Sure.
so yeah, if you know the condition of everything, you can kind of get an idea of, think of a worst case scenario. Like, okay,
Mhm.
so if the HVAC goes out and the roof goes out, you
Yeah.
know, this is how much we kind of need set aside. And that's what you have to be careful with, especially someone new coming in and they don't have a lot of money saved up, but they have enough for that 3.5% down FHA.
Mhm.
I think FHA does have certain rules that you have to have a certain number of reserves set aside, but it's
Yeah.
not a whole lot of money.
Mhm.
Um, so I would recommend setting aside way more than you probably even think you need, just to have that peace of mind, because no one wants to get that surprise $5,000 uh, bill that really kills your cash flow for the year.
Yeah. Okay. That makes sense. Yeah, do you think it's a case by case basis for FHA? I think one time I was talking with a banker and they said I needed 6 months of reserve of the monthly, what the monthly payment would be for the loan to do the FHA. But do you have any other experience with that? I'm not. That was a couple of years ago. I don't know if that's
Right.
still
Yeah.
true.
With lending, I mean, the lending standards change all the time. I honestly don't know exactly what their criteria is right now, but that sounds about
Yeah.
right. It's like probably 3 to 6 months, something like that.
Sure.
Um, and yeah, but it's a case by case basis, really, for the
Right.
investor. Like,
Mhm.
what seems to make sense going forward? If you own a
Mhm.
house and you have equity, maybe HELOC makes sense, but
Mhm.
maybe you already have the money saved up. Go conventional with 20% down, where you don't have the PMI, stuff like that.
Mhm.
Yeah, and we will get in one of our future videos coming up soon. We'll go more in depth with partnerships and how partnerships, especially with like private money lenders or someone else where you're pooling your funds together, how that can work out and help mitigate some of the risk and help you take down a deal. But I think for
Mhm.
your first one, you certainly can do it on your own.
Yeah.
You just kind of have to know just your options.
Right.
There's not just one option when it comes to
Mhm.
all this stuff. So just be aware that you have many options
Yeah.
out there
Yeah.
for sure. Do you have any questions like about any specific one, or do you know which one you would probably use for your first rental property?
For me, I prefer to do just a conventional loan, just because I feel like you're going to get the bank to double check your numbers because I want to make sure I'm not missing anything, and then it also gives you the insurance of having a home inspection and all those things. I know once you get a little more experience, a lot of those things can be things you exclude from a deal to help get a better price on it. So I think for me, having the double checking of the bank would be ideal for the first property.
Yeah, and you mentioned that makes me go think about the hard money. That one tip I will give, if someone does want to use
Mhm.
hard money at some point in the future, make sure that, like Billy was saying, that like kind of the bank is checking, numbers, they're doing the underwriting. Well, especially with a hard money lender, if they're not helping you vet the deal, like when they're looking at all your numbers, your rehab costs, what your ARV is, all that kind of stuff, if they're not, if they don't come back to you and say, hey, um, we think this might be a little tight, we don't really like it at this price, you're going to either have to renegotiate or find another property. So my first few hard money lenders, that never came up. I don't know if they were great deals because I didn't think they were like awesome deals. And actually, a couple of them ended up being pretty tight. So I think in those cases, they just wanted my money. They wanted to make money off of lending. But
Mhm.
one of the last ones I used, they actually said, "Hey, you're too slim on this one." And so I just went back to them. I'm like, "Well, what number makes sense?" And they said this number, and I went back to them and it's like, "Look, I can't. I'm gonna have to cancel the contract. I'm sorry." And I told the realtor, "Look, I'm like, I will come back with another number, but it's going to be lower." And so I did, and they accepted. So a little bit of a pain, but they were right,
Yeah.
and that
Right.
protected me a lot. So because it was roughly $10,000 or $12,000 less than what we had initially contracted at. So all that to say, it's nice to have someone else checking your numbers, giving you a second opinion because they want the
Mhm.
deal to go well for you too. If you're losing money, you're just going to have a bad taste in your mouth about real estate in general and of that lender. You're going to be like, well, hey, why didn't you help me out here? Now, a conventional lender is
Mhm.
not necessarily going to help with that stuff. Their job is more the underwriting. They
Right.
will help like in the aspect of like an appraisal because they don't want an appraisal to come in low.
Mhm.
They want to make sure that especially like the FHA or if you use, and we didn't talk about like VA loans. So if you're a veteran, you can get a VA loan. There are things
Mhm.
called USDA loans. So there's a couple other programs out there as well. But with those, especially the lower you go with down payment, there's more things in place. Like you got to have the reserves, and then the
Mhm.
property has to be in a certain condition. And if it's not in a certain condition, then they need that seller to either offer credit or fix those things before the buyer takes over.
Mhm.
So there
Okay.
are some precautions in place,
Sure.
but they're not going to tell you, most lenders, unless they're an experienced investor themselves, they're not going to say, well, you're not cash flowing very much. Although they'll look at things a lot of times,
Mhm.
like at your debt coverage and stuff like that. And if your ratios are off, they'll let you know there. But if you're analyzing the property ahead of time anyway, you're probably going to know those numbers. But it is kind of nice to have someone to double check that.
Yeah. Okay. Gotcha.
So that was a lot. that was a lot of stuff to talk about with financing.
Yeah,
uh, but yeah, I would say for most people, it's going to be the FHA or the conventional, possibly a Heloc. I know I had some friends and previous clients use Helocs because they had equity, and why not tap the equity in your house if you
sure,
can kind of use that simplified process
sure.
right there. So yeah,
How
quite a
much
few. Yeah.
equity do you typically need to get access to a HELOC? So,
Well,
for example, someone,
yeah, you're going to need more than 20%. So if you just
right?
bought a house in the last couple of years, you put 20% down, even if it's appreciated, they're going to
Hmm.
want a fair amount of equity because they
Hmm.
don't want to put you or them in a bind. I don't know an exact number, but I would say minimum you're probably going to need like 30-35% equity,
Sure.
possibly more to be able
Hmm.
to get into some of that.
Okay. Right.
Yep.
And how much did they allow you to take out?
That probably varies a little bit. That's a good question. Off the top of my head, I don't know, but it's not going to be all of it for sure.
Right.
It's going to be, a percentage. It might be 60% or something like that,
Okay.
but don't quote me on that. But that's easy to look up online.
Yeah. Yeah. That's what I figured. So, okay. Cool.
Yeah. All right. So that covers this episode, guys. Thanks for sticking around. If you have any questions about financing, just let us know. We'll see you in the next one.